Or what is going on, YouTube? It's Isaac Trade here with a quick tutorial on how option trading work, what you need to know about it, and just how a quick lesson on how I what I look for when I'm doing my option trading. So let me just jump right into this. Well, actually, before I jump into this, if you like my no BS approach, well, if you find my channel entertaining or useful anyway, please smash that like button and snap that subscribe. Now let's get into this option tutorial. Okay, option basic number one. There are two sides to every trade. Remember, this may seem obvious, but this is another way of saying that every trade has a buyer and seller. In the context of options, this means that every option trade, whether it's a call or put, has to have both a buyer of that call or put and a seller of that call or put. Remember that. Okay, in order for squeeze to work, you gotta have both sides. Okay, and in trade terminology, someone who is entering a buying position is considered long that position, and someone who is entering a selling position is considered short that position. This terminology carries over to calls and puts. If you're buying a call, you're placing a long call, and when you're selling a call, you're placing a short call. That goes both ways, whether you're just buying, if you're buying the shares or if you're buying the calls. And I mean, you got all you guys over here saying like, oh, when's the squeeze gonna happen? I just bought yesterday. Well, that's a short, you dick. Okay, excuse my language, but yeah, that's a short. Yeah, that's a short. Okay, you're basically doing the same thing. So stop being like the hedgies too and being like, you know, I mean, you guys do realize a long position isn't considered long with IRS until after 12 months. Okay, so I mean, you got a long way to go. Don't just buy it and like sell it. Okay, so back in the option basic calls, puts, and the outlooks. Okay, buying a call long, that equals a bullish call. Okay, you think the stock will be worth more later, so you want to lock in today's price to buy later at a profit. Okay, selling a call, that's short, that equals bull or bearish. Okay, you think the stock will be worth less later, so you want to lock in today's price to sell later at a profit. Buying a put, short equals bearish. You think the stock will be worth less later, so you want to lock in today's price to sell later at a profit. Selling a put long, that's bullish. You think the stock will be worth more later, so you want to lock in today's price to buy later at a profit. You know, you see how those works right there? If not, rewind and listen to it again, please. Okay, these positions and options in general give you the ability to put your money where your mouth is. Okay, when it comes to the stock, you're interested in. When you buy a call, you're bullish on that stock or the market overall, and that the price will be higher later. When you sell a call, you're bearish on that stock or the market, and think the price will be lower later. In both instances, you're trying to get a deal on the stock by locking in prices of the purchase or sell now. Options are a contract that gives someone the right to do something in the future under agreed upon terms. Sometimes in specific time frames calls for a type of option. Contracts that give you the right to buy a stock at a later date for a price that you agree upon. That right is valuable, which is why it must be purchased, typically for a premium. If the call buyer exercises his option to buy the call, seller is obligated to fulfill the transaction at agreed upon price. Puts are a similar mechanism to calls, just in the opposite direction. Remember that. Puts are a type of option contract that gives you the right to sell a stock at a later date for a price that you agree upon now. Puts are often used to protect the investments or gains that your holders have made. Like calls, puts also typically have a premium because you are purchasing the certainty that you can sell your stock at a fixed price at a later date. If the put buyer exercises his option to sell their shares, the put seller is obligated to fulfill the transaction at agreed upon price. Being in the money is a term you have heard before. In poker, it means in options it's straightforward. If your option contract is profitable to you as it stands now, you're in the money. This means you will make money by exercising that option contract immediately. In the money means making money, okay? That's bam, in the money, making money, baby. That's easy. Out of the money, oh, I'm not making money. That's not good. Okay, in the money versus out of the money. I'm gonna give you a quick example. Okay, say it costs $50, right, to buy $50. Okay, the stock goes up $50, that means it's in the money. Okay, the stock goes down to 40, oh, that means it's out of the money. Okay, you just lost $10 per share. If it went up to 50, when it was up to 60, then you made a profit of $10 a share. Okay, now on the put, let's say the put is $50 gives you the right to sell at 50. Okay, let's say the stock goes up to 60, you're out of the money. Okay, because you were betting against it. Okay, you should have bet against it, right? Makes sense? Not against it. Okay, so that was a loss of $10 per share. Let's say the stock goes down though, because you got to put on it. It goes down to 40. Well, you just made the 40. So you remember, this is just vice versa. Whenever you look at that, when you're looking at a call and a put, it's just flipped. Okay, that's all you got to remember. That said, savvy investors don't always want to exercise contracts that are in the money right away. Sometimes they think there are more gains to be made and are waiting for an even larger profit. And I think that's just wild. Don't do that. Every time I do it, unless you got a lot of time on these contracts, it usually turns around and bites you in the butt. I mean, that's how I figured it out the hard way. I mean, always get time with them. Don't ever give yourself a little bit of time. I mean, you're not gonna be like, well, you know, I can make that run on a good day in about 30 minutes, but I can do it today in 20. What? You're not gonna do that? I mean, what the heck? What's wrong with you? That's not how it works. We don't work like that, bro. Okay. If your options contract is out of the money, that means that you would lose money if you exercise your contract immediately. That means that if you bought or sold shares on that open market instead of using your option price in order, you would get a better deal. Generally, you do not want to do this unless you are afraid that things can get even worse, which, you know, that can't happen. I've seen it. I've seen it. Yeah, I mean, dang, man, I'm gonna tell you guys about the story with options when I first jumped in. So I just want you guys to have some clarity and understand. I mean, that's just a quick crash course on what they are. I mean, you want to buy a call, that means it's gonna go up. Like what I suggest to some of you new investors, like just play with one side or the other. I mean, you'll know when it's the time to play the put. You got to look at the charts. You got to understand how your stock works, how the asset behaves. You got to almost in a way, you got to be able to predict and like have like a second nature and be like, you know what, it's going to go. I feel like it's going to jump up here because, you know, you're never going to time it correctly. We're just trying to get near where that bottom or that top is. You're never going to time it right. And anybody tells you that oh yeah, man, I hit it every single time at the top and on the bottom, bam, there's like a 99%. You better slap that full hard, okay? Don't ever lie to me again, you bastard. Now, again, if you haven't already, please consider subscribing and liking my video, okay? That's a quick course on how options work. If you have any questions, please just drop them down below and I'll try to get to them when I can. I'm out, people. Be safe. Love you guys.